Well, we've certainly seen a meaningful correction across all the capitalization phases of the equity markets in the course of 2022. And our portfolios, which particularly growth-oriented, have certainly not been immune. That's created a bit of a challenge. If there's one thing we have noticed, it's that in this particular correction, we would have said that small and mid have done reasonably well, considering that normally their lack of liquidity tends to cause them to draw down faster when conditions turn negative. But in this case, we think we entered a market environment where the largest cap stocks in the global universes were perhaps the most overvalued. And so as we've looked at the performance of our strategy with a SMID orientation, it's really hung in there pretty well against its large cap peers and for comparison purposes. We are pretty sanguine about the opportunities as we look around the corner. One of the things that I think differentiates the way we think about equities versus perhaps what you get in the news is we're trying to invest in companies with a 2 to 3 year view. So it's very difficult to predict in the short term what forces are going to act on stocks, what forces are going to act on the global economy with a 1 to 2 quarter view, and what might create emphasis over a short period of time. But if we can find great businesses that are undercovered and underfollowed from a research perspective with a longer term view, then what we've found over 25 years in business is that those companies tend to grow their profits very nicely from a longer term perspective and really tend to get rewarded when the revenues and the profitability increase. So from where we're starting today with valuations much lower than where they were a year and a half ago, we're quite optimistic about the forward-looking view for the global discovery strategy. There's no question that 2022 has been a difficult year for global discovery and for growth equity investors in particular. One of the biggest challenges we faced is that with rising interest rates moving at an unpredictable yet rapid pace, it's been difficult for investors to come to terms with how to value stocks as we look out into the future. But one thing that has become very, very clear as the global economy reacts to this rising rate, rising inflation environment is that the economies are slowing. And one of the mantras that we've become to believe in very strongly over the last 25 years is that growth equity investing does extremely well in a slow growth economic environment. Part of the reason for that is that when growth is hard to achieve, those companies that can deliver it tend to be disproportionately rewarded. And we think with the portfolio we have, we've got a number of companies where if we can take a longer term view, their differentiated product and service set, high-quality management teams are going to lead to really great performance for us. So we continue to emphasize those businesses that have a powerful secular trend behind them. Perhaps that trend is selling software as a service. Perhaps that trend is biotech drug development. Perhaps it's renewable energy, or it's specialized semiconductors that find themselves ever more in demand for all the new products and services that we want. But whatever that category is, what we believe is that by being positioned in companies with strong secular growth potential and being light on companies who might cyclically face headwinds in a slow growth global economy, that we have a portfolio that can perform extremely well as we look around the corner. One of our largest positions in the portfolio is a company called Tektronix. It's a name you might not be familiar with, but you're probably highly aware of a couple of their most important brands. This is a company that makes power tools. Two of their most recognizable brands would be Milwaukee and Ryobi. The Milwaukee segment certainly is in high demand by professional contractors. Ryobi is probably the brand that folks like you and I would tend to buy when we walk into a home improvement store and are looking for a cordless drill. In any event, the interesting thing about this segment is that it's transforming dramatically as we cut the cord with tools that used to be plugged into the wall and now buy tools that are powered by rechargeable battery packs. This has taken the industry by storm, and it's created a powerful secular trend that even for a business that was historically very cyclical is now being powered by a change in the way your tools receive their energy. There's another leg to this into the future, which is to suggest that lawn equipment is going to move from using small gas-powered engines to the same rechargeable battery packs that power tools do. What we're finding is that the attractiveness of the battery ecosystem for Tektronix major brands is allowing them to take major share from their historical competitors. And it's giving people a very strong reason every time they buy a new tool to switch to this new method of energy production. So we find Tektronix to be a very, very attractive company, and as a result, with a 3-year view, are very comfortable with a large position in the stock. On Semiconductor is a business that's interesting to us in a couple of dimensions. One of the things that we are usually interested in is when a company gets a new management team that has a very persuasive and compelling strategy for how to take a company from perhaps middling profitability to more accelerated levels of profits growth. Another thing that we've talked about historically that we like too are companies that are well positioned for powerful secular trends. In the case of On Semiconductor, we find both of those things. A new management team has decided to focus the company very much on its 2 areas where it is one of the industry leaders, and to really de-emphasize those businesses where it's really a middling competitor. The 2 businesses where On Semiconductor has particular competency are image sensing chips and battery efficiency chips, both for automobiles. Now, we know autos are a cyclical sector, so why would we want to get involved in a semiconductor company that's heavily exposed to autos during a period of time when we perceive that an economic slowdown is around the corner? Well, the reason is their chips are focused on areas where we find more and more customers are buying those convenience factors. So, image sensors, those are your lane change assist sensors, they're your backup cameras, they're your adaptive cruise controls. Those are options that used to be only available on very expensive cars, but as we look at it now, you don't have to buy a $100,000 car to get all of those features. In fact, you can go buy a Toyota Corolla and get all of those image sensing factors that you want to get. And so we believe that even as car sales might slow, more and more of them will contain those. When it comes to battery efficiency, you care about range and how quickly your battery charges. And the chips that they make for that part of the business, where they're number 2 in the world, as we think about the percentage of cars that are battery electric vehicles, we believe that they're going to take continued rising profitability as we see the world evolve more away from internal combustion engines into battery electric vehicles.